I've been able to Mongolianise my presentation by putting in some scenes, which I hope you recognise. There we go. I'm obliged to show you this slide. I work for a company in Australia which invests money, and for that reason I have to give a disclaimer. I'm not going to say anything today to you which is going to take the form of financial advice. Notwithstanding, I couldn't give you financial advice. I can, however, give you advice on how to take photographs. And if you want to take a really good photograph, you've got to go to the Three Camels Lodge in the South Gobi. It's an outstanding location, and that's just been able to allow me to put some sensational photographs into this presentation. So I'm here today to talk about mining finance. And I think to capture that, you need to talk about what's been happening with mining equities first and foremost. So coming from Australia, I've brought an Australian example. These are the two biggest mining indices on the Australian Stock Exchange. The dark brown line is the major miners which are listed in Australia. BHP, Rio Tinto form part of that group, and they tend to dominate the trading. The orange line is the smaller cap miners. You are several hundreds of millions of dollars to $1 billion in terms of market capitalisation to fit into that line. And what I wanted to look at was what has happened in the boom which we have experienced in the last 8 to 10 years. From 2016, which was when that boom started, to sometime in 2022, the performance on those mining equities, and I think this is very similar to the performance that you see on mining equities globally, so that this is an Australian example still captures that essence globally. The large cap miners have almost doubled in that time. They've gone up about 95%. And to the peak of the market, those smaller cap miners, which are the ones which get better leverage to the improving conditions, have gone up by about 200%. So about a 3 times return on that group of stocks. But to talk about mining finance right now, you need to talk about what's happened in the last circa 2 years, because conditions have softened. This has happened against a backdrop of softening commodities. You can pick any time in 2021 or 2022. There was the peak of the market and things have softened since then. But compared to a lot of other cycles which we've seen in mining, these have been fairly unpronounced. We haven't seen rampant performance in commodities between 2016 and 2022. We've seen a strong performance, but nothing like what we would have seen between the year 2000 and say 2007 and 8 and 2011. But we have seen now quite a softening of mining equities. You can see that the big miners there have come off about 15-16%, and if you were in part of that slightly smaller group, 33%. What interests me is the exploration companies. In the global mining industry, these constitute more than 95% of the number of companies which are active in the space. Their equity prices have gone down something like 70%. This is an example I take from the Australian market. If you were to look at the Canadian market, it might be about the same. Some of that group of companies on aggregate have gone down by somewhere between 2/3 and 3/4, and their ability to raise money and then to transform that into activity on the ground has transformed massively. If I was to go, so in order to capture that essence then of what has been happening in the mining finance industry, I've switched from an Australian example now to a Canadian example. You need to talk about money which is raised. This is money which is coming into the industry, or if it's not coming into the industry, it's going out of the industry. It might be raised in certain times, but then in others, it is being sold off. So this is the aggregate amount of money which has been raised on the TSX-V exchange in Canada. This is the junior exchange where most of the small companies and explorers exist. And it just shows the amount of money which has been raised each year for the episode of this boom and now the bust which we're in. 2021 was a peak year, and the amount of money which has been raised in a year, even August to date, this has slowed down a lot. 2022 is still less than 1/3 of what was raised in 2021. So there has been a lot less money going into the mining space than there had been in those boom years. And this has an effect on the activity in the sector. It has an effect on the way that investors feel about the sector, and that's why you've seen those share prices sold off. So to present a little bit of an outlook, I think there's a couple of factors which I look at which guide my thoughts in terms of where to from now. The first one, which I haven't even written on this slide, and I should have, is we would expect a normal cyclical recovery at some stage. This is the interesting thing about mining, it is incredibly cyclical. In our business, we talk about it as a clock. I'm not going to show you the clock today, but the clock depicts how you go from boom to bust, to boom to bust, to boom to bust, and it goes around and around. And there are certain behaviours which you see within the entire mining sector, which give you a very good indication of where you are within that cycle. So these are the factors which I think indicate a little bit about the positioning of where we are at the moment. But I could say more confidently than anything else that we will have another mining boom. So some of these factors have more to do with the shape of that boom than that it's coming. I know it's coming, I just don't know when it's going to arrive. The bull factors, everybody's talking about when interest rates are going to come down, and that has a huge impact in the willingness that investors are prepared to have to take risks on their investment. And that impacts mining massively, particularly the exploration end of mining. Gold is performing. I can say that factually. In the last 6 months, gold has been one of the most phenomenal performances across the entire market for everything. So it's been a fantastic place to have investments. And that's beginning to influence the way that people feel about where they'll put their money. Gold is starting to draw eyes. Other commodities, there's an outlook for those which is encouraging. But then on the bear side, we've got two big economies in the world which still have reasonably large question marks over just how strongly they're going to be able to drive the demand for commodities. So I think when you're thinking about what this turning point is going to look like, and perhaps we've seen it, the gold price has driven the change from bust into the early stages of new booms in at least 2 of the last 3 cycles that I can think of. So this gold price performance is really encouraging. You've still got to check that with what's happening in the US and what's happening in China in terms of how quickly that economic activity can drive investment activity in the mining space. I wanted to talk to commodities briefly, and you can't talk about commodities without starting with gold. I think my slides are jumping a step ahead for us here, so there we go, back to gold, thank you. Everybody who talks about gold is going to show you a chart, and they'll show you real interest rates, which is interest rates adjusted by the rate of inflation, versus the gold price. There has been a very strong inverse correlation, so that if real interest rates are low, gold prices tend to perform. That's a chart which everybody will show you, so there's no need for me to go into that kind of detail. In fact, that's an interesting correlation which has existed on and off quite strongly for decades and decades, but for the last 20 to 22 years leading up to 2022, that correlation was incredibly strong. So I think the market had been conditioned to think that that is exactly what is going to drive gold. Real interest rates had headed in a direction that was not good for gold, yet gold had performed exceptionally strongly. I've just been casting around for the best fundamental that I can show you to really express how I feel about what might stand behind a robust gold price. We know that the price of gold has been priced from circa 2002 until about 2022. The marginal purchaser of an ounce of gold was Western ETFs out of the big financial centres in the West. In 2022, and most strongly in 2023 and then 24, that pricing power has shifted. It has moved from west to east. It is now the Chinese central bank, Asian consumers which are pricing gold, and that has brought about a fundamental difference in the demand side for gold. So I wanted to look at the supply side, because supply is what dictates how much gold is available for those purchasers. There's a heck of a lot of gold available in the world which sits in vaults, but it's not actually available for purchase. It tends not to find its way into the market even when the price is strong. So the chart that I'm showing you here shows the annual gold production going back to 1966, I think it says, and then the price of gold. The price of gold here, I'm using a logarithmic scale, so it doesn't exaggerate most recent price moves versus the previous price moves. What jumps out at me here is that in the early part of this, you've seen South African production fall off, supply of gold to the market decline, and you've had an enormous bull market in gold fall off of the back of that. In the early 2000s, you've seen global production level, and as that did and started to come off, you've seen another enormous gold bull market that has come off the back of that. So this learning for me is that when you see global gold production flatten, that can create the foothills for very strong gold bull markets, and that is precisely what we see at the moment. You can't even see the effect of the current gold bull market because I'm using this logarithmic scale yet. But I've got great confidence. If you look at the multiple returns that you can see in gold historically when these bull markets occur, that's what it could be setting us up for now. The most dangerous thing you can ever say about gold, though, is here's what I think the price is going to be. So I'm not going to go down that path, but we could skip along to... The other interesting commodity to look at then is copper, which is my next slide. It'll appear in a moment. There we go. So copper, if you go back, this is to 1970. Copper has some really interesting... It goes along for a while, it hits a point, it comes down, it hits another point, same level, comes down. And there are 3 cycles which I can see on this chart, a paradigm change in between each. You can see that in the 70s and the early 80s, copper struggled to burst above a level. In the 80s through to the 90s, it was the same again. This is what I see expressed here is the pain of purchasing copper, because anyone who purchases copper needs to pass that on to the people who are the end users of that product. So copper finds a level, buying behaviours change when it hits that high level, and then the price comes back again. This is not a speculation product. This is a physically used product. When China came into the market, it was the biggest pricing paradigm change for copper which has ever existed. So copper went from one level to something which was 2 to 3 times higher, and it has stayed materially above that. But you've seen this same pricing behaviour. I'm using monthly data. If you use daily data, you would see the same thing, but you would see those pricing peaks lined up very, very closely. So there is a point which copper pricing has been creating pain for purchasers, and that has been restricting its movement above a certain level, in my view. So the interesting thing is, if you think about the future for copper, what's coming down the pipe there? I don't think that it's China. China is still a big consumer. What's coming down the pipe towards copper is the energy transition, and this is one of the biggest themes in mining finance now, is what does that look like as new forms of demand start to influence pricing for things like copper and so-called critical materials as we go into the future. So I can see a robust future for commodities, and that's in a general sense. What I'm showing you on this chart then is to try and bring those 2 themes together, equities, and I'm talking about general equities, not mining equities here, global general equities and global general commodities. This is a ratio of an enormous basket of commodity prices divided by an enormous basket of equity prices, and in this case the equity price basket is the S&P 500, the US index. And this goes back to the 1970s. You can see that this moves from extreme to extreme, and the only way that I can explain that is that money sloshes from one side to the other, particularly as mining cycles take place, but there are equity market cycles as well, where money gets much more enthusiastic about certain themes. Where we sit at the moment is the largest extreme that we have experienced since the 1970s, and for a period of time now, rather than just hitting a point and moving back, where commodities are extremely undervalued in comparison to equities. So you see the tech theme, particularly in the US and the Asian markets. Tech companies with AI behind them are priced on incredibly high levels, and commodities aren't seeing any of that exuberance. It's much more driven by supply and demand. There's a lot less speculation in commodities. So I see this chart and I think, well, there is a point where this is going to have to swing back. The energy transition to me is the trigger for that, and the question is exactly when does that take place? But why does that drag money away from equities? Some of the most valuable companies in the world, in fact you could probably say the most valuable companies in the world now, are tech companies. Going back about 3 weeks, I woke up one morning, I was presenting at a conference, and Nvidia had fallen by circa 9.5% overnight, which didn't bother me too much. I wasn't an Nvidia holder, but the market capitalisation which was wiped off of Nvidia on the basis of being such an enormous company was huge. That one night of trading, it was a day trading in North America, that night of trading from my perspective had wiped off more market capitalisation from Nvidia in one night than the entire capitalisation of all mining companies listed on the Australian Stock Exchange. A whole sector's value wiped off. So there is an enormous amount of capital which is in the market, and it is available for repricing commodities, and with that, mining companies. That makes me extremely excited about what the next boom might look like. Changing pace a little bit, this is a visit to Mongolia, and this is Mongolia's premier mining conference. Mongolia is already a mining jurisdiction. It's nowhere near as significant in the global market as it will become. And I'm confident that it will. It's not a case of will it, it's a case of when will it. So I wanted to wind up with a discussion about the mining industry in Mongolia. And I think you might have already seen my chart sort of flip through from, these are just expenditure trends in exploration. So I managed to get access to exploration spend in Mongolia between 2010 and 2022, and then I overlaid that with the data from the Australian market. When they were on separate vertical axes there, the trends look the same. So the global pattern of investment is affecting spend in Mongolia in a similar way to how it is in the Australian market. But then when I put them on the same axes and price them in US dollars, you can see there's far more money being spent in Australia on exploration than there is in Mongolia. And I don't make this point to say, Mongolia, change your ways. My point here is, this is the opportunity. There was $2.8 billion US spent on mineral exploration in Australia in 1 year in 2022. That's an enormous amount of money. I think it was in the 50 to 70 millions of dollars in Mongolia. So you can see that money is available for investing in jurisdictions where there is an ability to do so. And Mongolia is much, much earlier in its evolution there compared to Australia. But this is the interesting thing, right? This is the opportunity for Mongolia, because there are countries in this world which don't have a natural mineral endowment. Your privilege here in Mongolia is that you do. It is as well endowed as Australia, as parts of Canada, numerous parts of Africa. But it is a unique jurisdiction in terms of the people who live here and the people who are going to be the custodians of that mining industry going into the future. And that is what paints the most exciting part of the future here. To finish off the contrast here, I wanted to wind it up with, if we're on an exploration theme, well, what is one of the things which could draw this investment into exploration in Mongolia? And at the moment, you've got to think of it as, if there is a cup and you want to fill it with water, the water is the money which is going to flow around the world. The biggest buckets in the world are going to hold the most water. At the moment, Australia's bucket for exploration is enormous. There is a huge amount of Australia which is available for investment in exploration because the existing tenure is there. Australia has 2,500 kilometres squared, 2,500 kilometres squared, 2.5 million kilometres squared under mineral licence at the moment, and that's 32.5% of the landmass. Like Mongolia, this is a country which has large areas which have very, very low population density, so it is a country where you can make that comparison of where people can explore without too many impediments. Mongolia, on the other hand, has 70,000 kilometres squared under mineral licence, 4.4%. So this set my mind running. Just imagine the money which is available, and you can see that from jurisdictions like Canada, Australia, money that gets spent every single year, and that is drawn by the excitement of discovery. We know that these deposits exist in Mongolia. Everybody talks about Oyu Tolgoi, but in 15 to 20 years, they're not going to be talking about Oyu Tolgoi on its own, because there's going to be 5 or 6 of them. And below that, there's going to be large mineral districts like the Kundi mineral district that I've been visiting this week, and the coal mining districts, which I was privileged to be a visitor of, hosted by a Mongolian mining company. These are not going to be individual mines. These are going to be parts of multiples on the basis of that discovery taking place. So as the ability to explore in Mongolia opens up, as that tenure system changes, I would anticipate that that money flows preferentially to this jurisdiction. Prime Minister was just talking about that and how cooperative and willing the government is to attract that foreign investment, and it is available, I can promise you that. So to finish up, I anticipate a cyclical recovery in mining. We're in a bust at the moment. It hasn't been severe. Unless you're a CEO of an exploration company, it would have felt that, but BHP and Rio wouldn't have. This hasn't been as severe on commodities and equities as it has been in previous cycles. I think that's coming to an end. We may already have seen the catalyst. Now, whether that's the gold price or whether that's stimulus in the Chinese economy, I can't be sure, but both of those have been very positive in terms of the outlook. Perhaps we've seen a catalyst. I'm not prepared to call it that yet, but we are approaching a turning point. And my conclusions on Mongolia are, this is a country with amazing internal capability. You can't compare Mongolia to immature mining jurisdictions like Africa, because there are so many countries which do require foreign assistance as well as investment in order to unlock them. All Mongolia requires is the investment. the capability, the intellectual capacity and the ingenuity, which is solving problems on the ground at the moment, is something which you don't even see in parts of the Australian market. That internal capability can be leveraged, and it will make for a tremendously exciting industry into the future. The geology here is exceptional. It is second to none now in terms of prospectivity globally, and that will attract funds. You just need the opportunity to do it. And I suppose the last thing I would say is that Mongolia as a jurisdiction is not someone who has sold their soul to any foreign master. This is a country where I think most foreign investors can feel quite comfortable on that basis, in that whilst it is surrounded by global powers, this is an area where Mongolia has maintained its individuality, and that is incredibly encouraging. So I would thank you all on behalf of the country Mongolia, which I've been visiting, for the hospitality which I've been shown, and I wish you all the best for the cycle to come, because I think it could be transformative from a Mongolian perspective. If we were to visit here again in 10 years, I think we're going to be talking about a far bigger industry than we have at the moment. All the best, folks. Thank you very much.